One of the most misunderstood concepts in all of wealth management is financial planning. And not only just the words financial planning, but when you specifically tie it to business owners. And before we dive into this topic, I want to tell you a little story that I think defines financial planning for business owners. So last year, I took my family to Disney World. We planned this trip back in December. I live in the Midwest where it gets very cold in the winter. I have 3 kids, all under the ages of 6. And when you're planning a summer vacation, you are not concerned about the 95-degree heat that you're going to be walking into in the middle of Florida. Well, turns out when you go to Disney World in the middle of July and it's 95 degrees, your 3 kids are all under the age of 6, get really hot and they don't want to be out in the heat all day long. So what do you have to do? You have to make a modification. You have to make a tweak. And I remember looking at my wife saying, I don't care what it costs. I don't care what we have to do. But we have to find some air conditioning for these kids so they can make it through the rest of this day. And the reality is that's a fun story, but it's very similar to a financial plan for a business owner where you can create the best plan in the world. You can even implement it. You can even show up on time. But the reality is the magic happens in monitoring that plan and making sure that you put yourself in a position that when changes happen, when life happens, you have a partner that can make sure they're steering you in the right direction so you can get the ideal outcome. My name is Luke Turner, co-founder of Moment Private Wealth. We help athletes and entrepreneurs get smarter with their money. Let's dive into today's topic, financial planning specifically for business owners. So in today's video, what we are covering is financial planning for business owners. And before we dive into what we have on the screen here, what we have planned out for you today, I just want to outline exactly what the framework looks like for business owners that we work with. So typically we break this down into 3 components. We have the create component, the implement component, and then the monitor component. So those are the 3 parts to every financial plan. So we're going to walk through those in order today. So first up is, how do we start the plan? What do we create and what are our goals? So from the creation perspective, it's very much focused on gathering information, asking the right questions, getting those goals in order. So before we talk about our sample client and the client situation, one of the things that I believe would be helpful is outlining how different questions and different answers are going to guide us throughout this financial planning process. So one of the most common questions that we ask is, what does financial success look like to you? And 2 very common answers we get are, 1, I want to work for the next X amount of years, call it 5 years. And then after that, I want to transition the business to my kids or I want to sell it. I really enjoy what I'm doing, but in 5 years, I do either want to cut back by exiting the business or by potentially selling the business to a strategic or private equity firm. That's one common answer. Another common answer to the exact same question, which is, what does financial success look like to you? For another subset of clients, it's, I'm burnout, I'm exhausted, I've been doing this thing for decades and I just want out. And in the next 12 to 24 months, I do not want to be working in this business anymore. How do I get the result that I can go down that path and I don't have to continue running this business? So the first part of that create section is all about goals. It's all about gathering information on what does success look like to you, whether it's financial or otherwise. So let's dive into the second section of that create, which is outlining this client's situation, gathering some of the financial information. So for this specific client, what we're looking at is we have a married couple. We have John and Mary. John runs a business. Mary's a real estate agent. John is making $1 million a year from his business, while Mary is making $100,000 from her real estate ventures. This is our income component. Our next component is our savings component. So you can see we have a couple items on here from a savings perspective. We have John maxing out his 401k as well as Mary. And then they're also saving $20,000 a month into a taxable brokerage account. And then lastly, we have our expenses. So we have our expenses in here at $20,000 a month. These are after tax, what it costs to live their life. This is one of the biggest things that we always want to make sure we're nailing down when we're doing financial planning for business owners, because oftentimes there's cars being run through the company or different things they're doing in their life that are being run through the company. We want to make sure we have a really good handle on what we are actually spending so that way we can plan around that figure. So that's the first portion of the create. The next is, what are our goals? So we always want to focus on where we're at, but then next we want to look at what are our goals actually going to be. So for this sample situation, what we have are our retirement goals. So John and Mary have explained to us that their goal is that they want to sell their business in 5 years. It'll be 2029. They'll be 45 years old. They want to spend $30,000 a month. So you can see it's a little bit of a change from what they're spending today. They would like to actually increase their lifestyle after they retire. Reason being is that they're spending all their time in the business right now, and they think there's going to be some things that they want to spend money on that will increase their cost of living after they're no longer running the company. And then, as I just mentioned, their last goal is they want to make sure that they are selling that business in 5 years. All of this is planned for the next 5 years in 2029. And the last thing is in 2030, once they start to really settle into this new normal, they want to look at potentially purchasing a $3 million dream vacation home. One of the things that we oftentimes advise is that when somebody goes through a big exit or they go through a large transaction where they're coming into significant money in a short period of time, settling into that new normal before making any very large purchases. So that's part of the reason why they're going to wait a year to actually look at buying this home in 2030. So those are their goals, both short-term and long-term. And the last piece to creating the financial plan, or that goals portion of the plan, is looking at what is our balance sheet and what is our net worth. And as a business owner, you've probably been asked this numerous times, especially as it relates to banking relationships and debt covenants, making sure that you have a personal financial statement. And it's the same on the financial planning side. One thing we're very focused on is making sure we're accounting for everything, whether it's retirement accounts like a 401k or a Roth IRA, or looking at what we think the valuation of your business is, making sure we have the valuation of your homes, bank accounts, brokerage accounts, everything that has a dollar sign, we want to make sure we're accounting for in this financial plan. So that is the create portion of the plan. Now let's look at the implementation. So how do we actually take all this information and put this into a financial plan that you can take action on? Once we have gone through that first portion, now we're going to be looking at the implementation portion of the financial plan. When we look at the implementation, it's very similar to the goals or the creation, which is we're going to have short-term implementation and long-term implementation. So we're looking at on this screen first is our short-term implementation. What we call this is our cash flow map. We build these out for clients at the beginning of every year so we can have a plan in place for what we expect our income to be, and then we expect to actually do with that income. So as you can see over here on the left, we have our 1.1 million in income. This is coming from the business, and then Mary's real estate income. We have our living expenses up here, what we think it costs to live our lifestyle. We have a tax projection we ran, our estimated taxes. Then we have our planned savings down here. We have our 46,000 that's going into our 401k. Then we have our 20,000 a month that's going into our taxable brokerage account. Keep in mind, one big conversation we always like to have with clients is when we set those goals, whenever we build out these cash flow maps, you always find that there's either excess money left over, or maybe we're short on the savings bucket. And we always like to bring this up because we want to be realistic that based on what we expect our income to be, making sure that every dollar is accounted for. And we know that there's going to be tweaks and changes we need to make along the way. But as close as we can get with every dollar, we want to make sure that we're doing that for our short-term implementation. So now that you've seen the short-term implementation, what does a long-term implementation look like? How do we extrapolate this out and look at what this is going to look like in the future? And really, we break it down into two components. We have the linear analysis, which is more of a spreadsheet format. And then we call it Monte Carlo analysis. So first, let's look at the linear analysis. This is a really great way to get a good idea, a good feel for what this plan is going to look like if we implement it. So we have our income flows for the next 5 years. We have our business we're selling for $20 million. We have our house that we're planning on purchasing for $3.5 million down here. It's a little bit more because of those inflation costs. We have our living expenses. We have our taxes, making sure that we're accounting for everything. And there isn't anything big that we missed when we went through that goal setting stage. One of the things that business owners ask us numerous times whenever we go through this linear analysis is, well, life's not linear. So what are we going to do when the market drops, or if inflation's higher than we expect, or we sell the business for less money than we think, or we make less money than we think we're going to make in the last 5 years? And the reality is that's why linear analysis is a great way to get a framework, but having a Monte Carlo analysis is the best way to account for those outside variables. So the second way that we look at this is what's called the Monte Carlo analysis, where we actually score your financial plan from 0 to 99%. And what this means is that if this number is 99%, what this means is 99% of the time we would expect to never have to make any changes along the way. We would take off on our plane ride from St. Louis to Fort Lauderdale, Florida. There would be clear skies. We'd take off and land, and everything would go as planned. But what this says is that 1% of the time we're going to take off and there might be a storm that's in the way and we have to divert around it. We're still going to get there in one piece. We're not going to let you crash the plane, but we might have to make a tweak. An example of this would be maybe inflation's higher than expected. Maybe we're spending more than we thought we were going to be spending. All these variables that you can never really know for certain until you're living it. So that's why we always like to look at that Monte Carlo analysis. But once we have this base plan, then what we do is we stress test it. Because as you know, as a business owner, one of the biggest things that you can't account for are those unknown variables that are completely out of your control. Think about these as those black swan events. And what we like to do is we like to focus on these stress tests. And some of the ones that might be near and dear to you is the market dropping suddenly. So an example of this was, what happens if I would have retired in 2007 and then 2008 happens? Am I still in a good place to retire? What happens if taxes are higher than we expect? What happens if I live longer than I thought I was going to? Or what happens if inflation is higher than we expected? And let's just toggle our inflation figure, because one of the nice things about the technology that we have access to is that we can stress test each of these with as much severity as we would like. So for example, if we expect inflation to be 1.5% higher than we expected on that 99% plan that we just looked at, all of a sudden our probability of needing to make an adjustment goes from 99% down to 80%. And what I would tell you is this is a great tool for us to be able to look at to give you the peace of mind that implementing the plan that we put in place is going to get you to the finish line. So that's the second component that we want to look at. How do we actually implement the nitty gritty? Now that we've looked at the first two components, creation and implementation, now let's look at how do we actually monitor this along the way. Okay, so now we're in the monitor section of financial planning. And what I will tell you is the monitoring of a financial plan is really where the magic happens or the nuance takes place. Because the reality is, like that story I told about taking my family to Disney World, plans change, things change. It's our job to make sure that we keep you on track and we keep the guardrails up to make sure that you get to your destination with the timeline and the goals that you expect to meet. So what we're going to look at here is a real life example. So we just met with John and Mary, and they told us that the business hasn't been doing as good as they were hoping, and valuations in their industries actually decreased. So instead of selling their business for $20 million, now they think they're only going to sell their business for $15 million. But what they asked us was, what happens if we end up selling the business for, instead of for 20 million, we only sell it for 15 million? What does that do to our financial plan? So what our job now is to look at and say, okay, our plan was at 99% before. Now we've moved down from 99 to 93%. So there's about a 7% difference in us potentially needing to make an adjustment in the plan. Okay, so the last component to any great plan is what we would call the monitor section. So we have create, implement, and monitor. And what I would tell you is monitoring is really where the magic happens, where the nuance happens in financial planning. Because the reality is financial planning is very much like running a business. There are going to be things out of your control. Things are going to change. It's never going to go exactly as you plan. And our job is to make sure that we keep you on course. So what we're looking at here is we just met with John and Mary, our sample clients, and John told us that the business isn't doing as well as he thought, and business valuations have decreased in their industry, down a couple of turns. So what we've done is we've now adjusted the plan saying, well, we expect in 2029, John's going to sell the business now for 15 million instead of 20 million. And they've asked, well, if that situation occurs, what does that do from our plan? And we're able to show them that the plan has changed from 99% chance that we don't need to make any course corrections to a 93% chance that we don't need to make any course corrections. The important part in the monitoring is not that things potentially will come up and we'll need to potentially add variables. The goal is that we give you, the client, the path forward of how to meet your goals in the timeline that you want to meet them. And part of that is, again, going back to these stress tests and making sure that we're putting ourselves in a situation that when we are looking at these variables that are out of our control, we're being very aware of what could happen. And for John, one of the things that he had mentioned is not only is he worried about potential inflationary pressures, but he's also worried about a drop in the market. So one of the things that we showed John was, well, what happens if we sell the business, you retire at 45 years old, and there's a 40% drop in the market? And to his surprise, one of the biggest changes is that this is now going to drop the probability of us needing to make an adjustment from 93% only down to 88%. And at 88%, we'd still feel in the plan set forward. But what I would tell you is the only way for that plan not to have a significant drop is by having the right investment strategy and the right investment allocation. So when we're thinking about financial planning, we're thinking about creating, implementing, and monitoring, we need to make sure that we're putting together all the different components of a wealth management plan for business owners. And if you're wondering what those components are, check out the link below where we have a blog that outlines all the components to a wealth management plan for business owners.